Hi, my name's Tom Clendon, the SBR online lecturer, and today's podcast is about impairment, IAS36, impairment of assets. Now, an asset is impaired when the carrying value exceeds the recoverable amount. And that's a really important statement to understand. So an asset is impaired if the figure in the books, the carrying value, let's say 100, is greater than the amount that the business can recover from that asset. So if we can only recover 90 from the asset, and it's in the books at 100, we must write that asset down to 90, and we're going to recognize an impairment loss of 10. And normally that impairment loss of 10 will be charged against profit. So you're debiting the profit by 10 and crediting the asset by 10. But what do we mean by the recoverable amount? Well, there are two ways that you can recover money from an asset. One is to keep it, exploit it, use it to generate cash flows in the future. There's a value in using the asset. Yeah? And that value from using the asset is the present value of the future cash flows. The estimate of the monies we think we're going to get in the future discounted back in today's monetary terms. So one way of determining the recoverable amount is the value in use, present value, future cash flows. The other thing you can do with an asset to get money from it, instead of keeping it, in other words, if you've got a property, you rent it out and you look at the rental income, instead of keeping it, you could sell it, exit, market value, fair value less cost to sell. So the recoverable amount is either the value in use or the fair value less cost to sell. And we will always take the higher because that's common sense. You know, if you think by keeping the asset you get 90, but by selling the asset you'll get 70, you wouldn't sell the asset, you'd keep it. The amount you would recover would be the higher of the fair value less cost to sell and the value in use. So we talked about that 10, that impairment loss normally being charged to profit. But technically it is possible that if the asset has previously been revalued, you would charge the impairment loss not against profit, but against the revaluation reserve of that asset, and therefore it would be charged effectively against other comprehensive income rather than impacting on the P&L, rather than impacting on earnings per share. Let me give you a simple example. Let's take the issue of land. Let's keep it simple. If we buy some land for 10, and then a year or two later we revalue it to 12, therefore we'd recognize a gain of 2 in equity, and then a year later the asset is damaged, the market value falls or the land becomes polluted in some way, so the recoverable amount of the land is only 9. So if you've got an asset which has been revalued to 12, carrying value is 12, but the recoverable amount is 9, well, hopefully we don't need a calculator. The impairment loss is 3. Now, because the asset has previously been revalued, you can charge that 3 to reserves, to other comprehensive income. Well, no, you can't. Well, yes, you can. Because you can only charge it to equity to the extent of the balance on the reserve. Once you've exhausted that revaluation reserve, you're back then to charging the P&L. So because you've only got 2 sitting in the reserve, of the impairment loss of 3, 2 would go to equity, 2 would go to other comprehensive income, 2 would go to reserves, and then you would have a further charge of 1. So the journal to the P&L. So the journal entry would be debit reserves 2, debit P&L 1, and credit the asset 3. So you're writing the asset down to the recoverable amount. Once you know an asset is impaired, you must write the asset down to the recoverable amount. And let's just think about the impact of impairment, the impact on the cash flow. Well, basically, there isn't one. No money is changing hands. What you do in a cash flow, the indirect method, is you add back depreciation. When you're reconciling, you add back depreciation because it's a non-cash expense. So to the extent that you've charged an impairment loss against profit, you'd add it back in the cash flow, but it's not a cash flow. You're adding it back in the reconciliation. Deferred tax. Well, if you've got an impairment loss, you're reducing the carrying value of the asset, but it will be ignored for taxation purposes. And because it's ignored for taxation purposes, the tax base remains the same. So the carrying value is going to fall, the tax base is going to remain the same. We've got here a deductible temporary difference. It's going to create a deferred tax asset. So there is a deferred tax implication to impairment. Now, I think I'm going to leave it there for now. There's another whole story about the impairment of goodwill and how that has to be done at the level of a cash generating unit. But I just wanted to give you a little reminder of the basic principles around impairment. If you want to read more about impairment, go to Google. My surname is unusual, Clendon, C-L-E-N-D-O-N. If you Google Clendon and the word impairment, you will find various articles that I have written that have been published by ACCA in this regard or been published by me on LinkedIn. Okay, if you don't follow me on LinkedIn, that'll be a good thing to do. But thank you very much for listening today.